Gold is not getting more expensive. The measuring stick is breaking. That sounds subtle, but it changes everything. Every chart you see treats the dollar as stable and gold as volatile. But history flips that assumption. Gold doesn't adapt. It doesn't respond to policy. It doesn't care who's in charge. Fiat currencies do. And when they weaken, gold doesn't rise in value. It exposes the loss. Here's a concrete example. In 1971, 1 ounce of gold cost $35. By 1980, it cost $800. Same metal, same weight, no upgrade. What disappeared was purchasing power, about 94% of it. But here's the part most people miss. That collapse didn't look dramatic while it was happening. Currency markets still functioned. Exchange rates still traded. Life went on. Today feels similar. The euro and the dollar look stable against each other, almost unchanged for decades. That stability feels reassuring, but what if it's not strength at all? What if it's two currencies weakening together? Because if that's true, then rising gold prices aren't the story. They're the symptom. What's unfolding now isn't an isolated market move. It's part of a much larger pattern, and you only see it if you zoom out. Officially, the narrative is calm. Currencies are stable. Inflation is managed. Markets are orderly. But that calm depends on one assumption, that fiat money is still a reliable reference point. And that's exactly what's quietly being challenged. Here's the key detail. For more than 20 years, the euro-dollar exchange rate has barely changed. To most observers, that signals balance. But balance between what? Two systems expanding debt. Two central banks increasing money supply. Two currencies losing purchasing power at roughly the same pace. When everything drifts together, the drift becomes invisible. Now watch where the signal actually shows up. Not in FX markets, not in bond yields, in gold, across currencies, across regions. New highs, not because of speculation, but because it's the only place where absolute value still shows through. This reframes the entire issue. The question isn't whether gold is in a bubble. The question is why every major currency needs more of itself to buy the same ounce. And once you ask that, the story stops being about markets. It becomes about measurement itself. There's a claim hiding underneath all of this, and it's uncomfortable because the math backs it up. If this cycle truly resembles the last major currency reset, then the numbers people dismiss as impossible aren't extreme at all. They're proportional. Between 1971 and 1980, the dollar price of gold rose roughly 2,700%. That wasn't enthusiasm. It wasn't a fad. It was the numerical consequence of currency expansion colliding with reality. Apply that same percentage logic forward, and the implied prices sound shocking. 10,000, 25,000, even higher. But the shock comes from anchoring to old prices, not from the math itself. Here's the concrete detail that breaks the illusion. At low price levels, gains are hard. Moving from $2,000 to $3,000 requires a massive percentage jump. But once prices rise, the dynamics flip. A move from 9,000 to 10,000 is barely double digits. From 19,000 to 20,000 is almost trivial in percentage terms. Now notice what's missing from the debate. No serious alternative model explains how purchasing power is preserved without a repricing somewhere else. No currency offers it. No bond market guarantees it. That absence isn't noise. It's the signal. Once that signal appears, it doesn't stay contained inside charts. It spills into behavior, policy, and eventually geopolitics. We've seen this escalation before. In the 1970s, the system didn't break suddenly. It normalized stress. Deficits became routine. Monetary expansion became policy. Each step was framed as temporary, necessary, responsible. Over time, the exception became the rule. That same normalization is visible again. Debt levels that once would have triggered alarm now barely register. Central bank balance sheets remain bloated, not because of crisis, but because shrinking them risks instability. What used to be emergency intervention is now baseline maintenance. Here's where the story flips. When weakness becomes normal, markets stop reacting to it. They adapt, and adaptation quietly changes incentives. Holding currency stops being neutral. It becomes a decision with downside risk, not dramatic risk. Slow, persistent erosion. Gold doesn't need fear to rise in that environment. It just needs the system to accept that tomorrow will require more intervention than today. And once the system accepts that premise, reversal becomes harder than continuation. That's when escalation stops looking like a crisis and starts looking like momentum. The next layer isn't theoretical at all. It's visible in what states are doing, not what they're saying. In 2022, a line was crossed. Sovereign reserves were frozen. Assets held by a central bank were treated as leverage in a geopolitical conflict. That moment quietly rewrote the rules of the system. It sent a message that didn't need a press release. Reserves are only safe if they're politically aligned. Here's the contradiction that matters. Publicly, the dollar is still described as the world's neutral reserve. Privately, countries are acting as if that neutrality is conditional, and the response hasn't been subtle. Central banks began moving away from paper claims and toward physical assets that can't be frozen, cancelled, or digitally impaired. Gold sits almost alone in that category. It's liquid, it's non-sovereign, and if it's held domestically, it's untouchable. That's not ideology, that's logistics. Notice what didn't happen. There was no announcement of a new system, no declaration of distrust, just a quiet strategic reallocation, slow enough not to cause panic, large enough to matter. Once reserves are treated as weapons, holding them becomes a risk calculation, and that single shift permanently changes how value is stored. Now the pressure stacks fast, not in one place but everywhere at once. Debt ratios are rising across the developed world. The United States carries levels once associated with crisis economies. Japan's numbers are even higher. Parts of Europe remain structurally fragile. On paper, these are different situations. In practice, they all point to the same constraint. There are fewer and fewer places for surplus capital to hide without taking on sovereign risk. Here's where the system starts losing flexibility. If US debt looks stretched, where does capital go? Europe brings its own solvency concerns. Japan offers scale but extreme leverage. Rotating between them doesn't reduce risk, it redistributes it. At the same time, fiscal policy remains expansionary. Political uncertainty keeps rising. Shutdown threats, trade friction, policy reversals, none of this collapses confidence overnight. But it compresses it. It shortens the time horizon markets are willing to tolerate. So capital starts behaving differently. It becomes more defensive, less patient, less forgiving. It looks for places where rules are simple and don't change with elections or emergency meetings. And that leads to an uncomfortable question. What happens if this pressure doesn't release, but compounds? At this point, the impact stops being abstract and starts showing up in everyday life. Because when currencies lose credibility, it doesn't arrive as a headline saying, reset. It arrives quietly. Savings don't go as far as expected. Prices fall slower than they rise. Long-term planning feels harder, even if incomes haven't collapsed. The system still works, but it works against you in small, persistent ways. Notice how the burden is distributed. Governments can borrow. Central banks can adjust frameworks. Large institutions can hedge. Individuals can't. You live inside the currency. You're paid in it. You save in it. Your future obligations are priced in it. When its purchasing power erodes, you absorb the loss by default. This is why gold keeps resurfacing during these periods, long before it becomes fashionable, not as a get-rich trade, as an opt-out, a way to step outside a system where the rules quietly change mid-game. If this feels familiar, say so in the comments. Most people recognize the pressure before they can name it, because once monetary stress reaches daily life, it's no longer theoretical, it's lived. What makes this phase dangerous isn't panic, it's design. Modern financial systems reward leverage, confidence, and speed. As long as trust holds, debt expands, and assets rise together. But when trust thins, that same structure flips. Leverage becomes fragile, speed becomes destabilizing, and anything that depends on promises starts carrying hidden risk. Gold sits outside that architecture. No issuer, no yield to defend, no counterparty. That's why it behaves differently when stress builds. It doesn't need growth or optimism. It just needs the system to become more complex, more political, and harder to trust. Here's the unsettling insight. This isn't about inflation versus deflation. Gold performs in both. In deflationary collapses, capital flees failing credit structures. In inflationary cycles, it escapes currency dilution. Different paths, same destination. What allows this to happen is incentive alignment. When policy becomes reactive and credibility conditional, capital doesn't wait for clarity. It seeks simplicity, assets that don't require interpretation. Once enough capital makes that shift, the behavior reinforces itself. Not through headlines, but through balance sheets and reserve policies. That's when a hedge quietly becomes a foundation. From here, the path forward splits, but neither option restores the old normal. In one scenario, the system stabilizes on the surface. Debt keeps expanding, but slowly. Inflation is managed, not defeated. Confidence doesn't collapse, but it never fully returns. In that world, gold doesn't crash. It holds its ground. Elevated prices become the cost of maintaining order. The problem isn't solved, it's stretched over time. In the other scenario, pressure accelerates. Political risk bleeds deeper into monetary decisions. Trust erodes unevenly. Small shocks create outsized reactions. Capital stops assuming tomorrow will look like today. Repricing speeds up, not because of panic, but because inertia breaks. Here's the key point. Both paths accept the same reality. Fiat systems don't regain their old credibility. The difference is velocity, not direction. And markets are already preparing for that uncertainty. Not choosing sides, positioning for instability itself. Because once momentum starts forming in a repricing cycle like this, the next move rarely announces itself. It simply arrives. Here's the part most people miss. This was never really about gold. It's about trust in measurement. When the unit used to price, everything becomes unstable. The distortion shows up everywhere at once. Assets feel expensive, cash feels weak, planning feels harder. Gold just makes that instability visible. It doesn't create it. What you're watching is not a speculative cycle, it's a structural adjustment, a slow migration away from systems built on promises towards something that doesn't need enforcement or explanation. That's why this move doesn't end with a pop or a crash. It ends when the underlying pressures change, and they haven't. The next chapter of this story won't begin with gold prices. It will begin somewhere else breaking, somewhere people didn't expect. If you want to see that, before it becomes obvious, stay with the analysis. Because by the time everyone agrees on what's happening, the repricing is already over.